entrepreneur Pankaj Tibrewal joins us now. क्या नाम रखा है फंड का? Ikigai. It's inspired by a Japanese philosophy. Stay calm, stay still, right?
Yes, Nikhil, it means purpose of life.
Purpose of life. And is that the entrepreneurial spirit now for your new venture?
Absolutely. I think every one of us has an ikigai inside them. And the basic purpose and motto of the firm is trust, process, and performance. And can we discover the compounding of ikigai, which we want to do on the wealth side for every investor of ours?
Okay. So let's understand what is the way forward now. You've been calling out for a correction in the mid and the small cap space. The correction has happened. Is the correction deep enough now to warrant a revisit in small and mid cap stocks?
So, Nikunj, let's look at the data. Over the last month or so, mid and small caps have corrected. The index has corrected by about 9 to 10%. We believe that the recent correction is very small compared to the larger returns in the past 1 year and 3 years. And still believe that excesses are there in certain pockets in the small cap, especially, and in the SME part of the market. We believe that market has started to take cognizance of that, and whatever excuse may give, this probably was, it's not come as a surprise to most of the market participants. We believe that there are 3, 4 indicators we need to keep in consideration. One is the profit and the market cap distribution. If you look at mid and small caps as a percentage of total overall market cap, it's about 35%, whereas the profit distribution is about 25%. So still there is a decent gap between profit and market cap distribution as we speak. The second is that if you look at the trailing earnings yield minus bond yield, it's at the worst level for mid and small cap since 2005. And history suggests that the next 12 months generally tends to be negative once you hit that ratio. The third part is that from the last 1.5 months, if you notice that the median returns of the index was already negative or inferior compared to the index returns in mid and small cap. That means the larger pocket of the market was already seeing correction, whereas the index was holding up because of the few heavyweights in the index itself. And I think that started to show that the breadth of the market was deteriorating. And in my view, it's just probably the start. Earnings momentum probably has started to slow down. Third quarter, we saw the least number of positive surprises in the last 7, 8 quarters. And the liquidity is extremely tight at the ground level. When I'm speaking to across the industry participants, the sense which I'm getting is that the demand is also slow and liquidity is also very tight, which means that the working capital cycle will get elongated for a lot of companies as you move into the fourth and the first quarter. So I think finally, at some point of time, stocks are slave of earnings. And if there is earning disappointment as you move ahead, then there could be pressure on certain sectors and markets. So we feel that still some time to go before we start bottom fishing the markets from a mid and small cap perspective.
When you were managing public money in Kotak, you had a portfolio which had an historical presence, and you had to manage risk. Now you're starting fresh, which means you'll have to take a fresh card. You have to option to invest differently, invest fresh, and take a different time frame. So in this portfolio, when you will start managing public money, what are you likely to buy? What are you likely to avoid? What are the themes you're bullish on?
So Nikunj, basic investment philosophy will not change, which I have been following over the last 2 decades, which means buy quality companies run by great promoters at reasonable valuations. I think that philosophy today also offers decent opportunity in many pockets. For example, pharma today is looking still very attractive. If you remember, in the last 1 year back, we have been calling pharma as a dark horse. And I think to a certain extent is played down. I think still 1 more year to go. So if you were to, it's a 2 year journey. I think we have reached halfway in the pharma sector. And I think the US generics can further surprise most of the participants in the market. And the price erosion has got arrested in the US generic side. So that will lead to positive earning surprises in the pharma sector. One sector which is probably not participated in the rally and is at the levels of 16, 17,000 of Nifty is chemicals. We believe that the worst is behind, but it may take a couple of more quarters finally to see the demand revival happening back, because Chinese imports are playing a havoc on the pricing in the chemical sector, which may take a couple of quarters to settle down, but prices are reasonable in certain pockets of chemicals. And we believe that's, if you would take a 3-year horizon, that's one thing to probably look at. The another one is the private sector banks. I believe that we have seen the shift over the last 2 years and underperformance from of private sector banks and outperformance of PSUs. We believe incrementally valuations are looking much more attractive in the private sector banks. That's one other spot to look into. Another sector is the light engineering, capital goods, and consumer durables. The real estate rally has happened, but we haven't seen that percolate down to the second derivative in home building plays, consumer durables. We believe that will happen with a lag, and probably the second half of FY25 could be a revival of demand on the consumer discretionary pockets, consumer durables, home building, and that's one space which has not participated. Valuations have started to look reasonable. There are strong balance sheets, return on capital is strong, franchise names are strong, and that's one another pocket we could look to invest over the next, keeping in 2 to 3 year horizon. So that's something which probably are looking good. What to avoid is low free float stocks, checkered promoters, checkered management teams, balance sheets where reasonable amount of leverage is there, and probably should be avoided. And many companies, Nikunja, I'm seeing that they don't make operating cash flows also over the last 3 years, 5 years. But the market narrative is so strong that they have been re-rated significantly to 30, 40 times. I think some of those pockets we need to avoid and make sure that we make less mistakes during this bull market. I think finally, when the tide turns down, we know the difference between men and boys. And I think next 6 months could be a crucial period for all of us to reassess the risk in the portfolios and make sure that we make less mistakes. Mistakes will be made by all, but finally, when the tide turns down, we'll come to know who is swimming and who is naked.
So, Pankaj bhai, you've spoken like a true fund manager, but when you are an entrepreneur, things change. So I'm hoping that things will change here. Let's talk stocks, let's talk more themes, let's talk more ideas. At least that compulsion is not there. So let's talk about what you like. I mean, let's be specific in terms of names then.
Nikunj, my philosophy always have been that don't tag yourself to one company. I think broadly, my thought is that we should talk about sectors, overall thoughts. Individual companies, probably may not be that comfortable either being a professional or being an entrepreneur. And I think the basic foundation remains the same. And I think by carrying those value systems, I think we want to build IKIGAI over the next 10, 15, 20 years. So in a way, specific stocks I will kind of avoid at the moment.
Fair enough. But Pankaj, curious to get in your take on the entire banking space, because now it seems that after we've seen the exuberance play out within the PSU banking space, the preference is leaning more towards some of the private banking names, which maybe haven't performed quite as well. What's your outlook on how one should be playing the private versus the PSUs?
I think rightly so over the last 3 years, if you look at, there has been a significant improvement in the ROA, return on assets of PSU banks, which has led to what the outperformance of PSU has been versus private. Most of them were trading at 0.3, 0.4 return on assets. Now they have moved to 1% return on assets. Further improvement from here seems to be difficult because maximum improvement in PSU banks have come because of credit costs coming down, not because of operating parameters improving significantly. So we believe that as liquidity starts to tighten, and we have already seen that deposit mobilization is becoming a difficult task for most of the banks, we believe that operating parameters beyond credit cost will now be highlighted. And I think there, private sector banks have a decent franchise. Some of them have managed the liability side over cycles. And we believe from here on, valuations have corrected meaningfully. Most of the private sector banks are between 1.5 to 2.5 times price to book. And I think there is a reasonable case that the portfolio now should be tilted towards private sector banks, and maybe few of them the large public sector banks should also be part of the portfolio, because further improvement from 1% ROA to 1.5 looks difficult in the near-term environment for PSU banks. Hence, we believe that the super rally which we have seen in PSU banks may come to a stall, barring few of the names, and hence preference towards private sector banks, more towards a defensive nature of the business as we speak.
We're just scratching our head as to what's going to act as a trigger for the market. While, this small and mid-cap ease-off seemed very much induced, given the commentary that you had all around. But outside of the MF stress tests, what do you think is going to act as a major trigger for the markets? And do you think it'll be earnings next?
So in my opening remarks, if you, kind of paid attention to, I spoke about earnings momentum kind of started to slow down. Third quarter, you saw that maximum earnings growth came from margins, improvement in margins, which my belief is from the fourth quarter onwards and to the first quarter, the base may not be that favorable and margin levers have started to be missing. And the top line growth is sluggish, about 3, 4, 5% is the top line growth for the NSE 500 companies. And that probably could come as a, kind of a headwind from a stock market perspective. And our belief is that the rally will become narrower and narrower as you move ahead. And companies with positive earnings surprises will be rewarded disproportionately as you move on. So we need to be very careful in the kind of companies we are investing in. Low free float stocks, checkered promoters, inferior balance sheet and cash flow should be avoided. Low return on capital business should be avoided. Don't get flowed with the narratives and stories which are floating around in the market. And we believe that if we can do that judiciously, I think the portfolio will be least impacted whenever the markets kind of correct. And we have started to see early signs of that, and be very choosy in the companies you invest in. So that will be some of the advices for your viewers. And today, when I look at retail, a large part of their corpus is invested in small caps, as seen from the shareholding of small cap names. Retail is the largest holders out there. Make sure that you do your due diligence properly before investing in stocks.
Categorical piece of advice. Pankaj, great to have you on the show as always, and many congratulations on your journey at IKIGAI Asset once again. In the meantime, let's just take stock of what the...
If you like this video, then like, share and subscribe to ET Now.